Well, hello. For this first lesson, I want to introduce you to the concepts of accounting. Now, accounting is not something engineers typically do, and what engineers will do is use the information provided by the accounting department to help make better decisions when they're making investments in various projects. So, couple of questions. We want to understand who uses accounting reports and why. What makes accounting reports possible? This third bullet point, what is the general accounting equation? That's sort of fundamental. And finally, what is the difference between cash and accrual accounting? So those are kind of the four takeaways that I want to have from this lesson. So who uses accounting reports and why? So financial accounting is used by external people. Well, what does that mean? And managerial is used by internal people. So what's the difference? Well, think about a publicly traded company. Now that's a company like Apple, like Chevron, that has stock. And people that want to invest in stock have to have information about the company. So they are investors. And then other people, creditors, these are the lenders to the company. They want to know things about the company to decide if they want to make a decision whether they should lend them the money or they're going to get repaid or not. Customers. If you were considering buying a car and the company you were considering purchasing it from was about to go into bankruptcy, you might not want to purchase the car from that company. And the reason being that they might not be able to supply parts in the future. Or, one of your customers might be supplying materials to the company. They need to understand how the company is doing financially. And then finally, taxing authorities. Taxing authorities take financial accounting reports to determine the credibility of the tax return. So those are the external users. Now, internal users, sorry about that. The internal users are typically managers, owners, employees. They want to assess the company's performance. Now, obviously, investors want to assess the company's performance, but these are more hands-on. They're from very close and close to the vest, as opposed to investors who don't need to know all the details. So, and then they might want to decide if you want to expand or downsize an operation. Is a certain branch of the company more profitable than the others? We have, if we want to borrow money, where would we want to invest it? If we generate cash in the company, do we want to invest it or give dividends to our investors? And so those are the people, the internal users, those are the types of things they might do with accounting data. So there's financial accounting that external users use, managerial accounting that internal users use. Typically, from your perspective as an engineer, you're going to be looking at accounting from an internal perspective in order to help you make better investment decisions. That's from a company perspective. Personally, you might be an investor and want to look at some of the financial accounting, and that is so that's a separate use you may want to do. You're probably never going to be a creditor to a major company. Potentially, if you have a small business, you might be a customer of a company, and highly likely you wouldn't be part of a taxing authority as an engineer. Now, what makes reports possible? And what makes accounting reports possible is you gather data. Accounting is historical. It looks at what has happened in the past And some of the things we as engineers do when we use accounting data is we say, okay, well, this happened for the last 3 years. Is it likely to be happening for the next 3 years? And so it's historical. It's typically measured in monetary value. Now, if you look at some annual reports, there are a lot of other things besides dollars, but accounting reports are recorded and measured in monetary amounts as opposed to number of iPhones sold, for example, from Apple. The accounting had a transaction. The dollars for a transaction is only recorded on the accounting books when it occurs. So you may discuss with somebody the concept of a sale, but until the sale occurs, it's not recorded. It hasn't happened. And there's two terms that you may hear when you talk with people about accounting reports and managerial accounting: FASB and GAAP. FASB is the Financial Accounting Standards Board. That's a group of accountants that put together generally accepted accounting principles. So there's a board, it's an independent board, and what they do is they have generally accepted accounting principles which are applied to all companies. So a company will file their reports, and the reports will be done utilizing GAAP principles. Oops. Now there's several items when you look at accounting statements and talk about accounting. There's assets, liabilities, revenue, expense, and shareholders' equity. Now, assets are things that you own. So a company has assets. The company has assets. Cash is an asset. Accounts receivable, that's a sale to somebody or some company where they have agreed to purchase something and then they're going to pay within 30 days, for example. It's called a receivable. So it's kind of like cash. Inventory is if you produce something and you haven't sold it, it goes into inventory. Equipment would be machinery that the company owns, and property is, sometimes machinery is classified as property, or property can be considered things like land, buildings, things like that. So those are assets, and if we think of a balance sheet, assets show up on the left-hand side of the balance sheet. Now, assets are at a point in time. So you know how much cash you have in the bank on December 31st or March 31st, for example. It's at a specific point in time. That's the same with liabilities. Liabilities are things like loans. It's money that you owe. Like if you took a loan out to purchase some equipment, it would be a liability. An accounts payable is the inverse of an accounts receivable. You've bought something and you're going to pay it off within 30 days. It's called a payable. So that's on the right-hand side of the balance sheet. And then shareholders' equity is basically the money that is raised. You can think of it kind of like a loan, but it's the ownership of the company. So the shareholders' equity is when the company issues stock and receive money, cash into the corporation, and it uses that cash to purchase equipment, to build things, to buy properties. And then if the company makes money and doesn't pay it out of dividends, then it is retained earnings. Now, I know this is all kind of new to you. Let me go to the next slide before I come back to revenue and expense. But let's think assets, liabilities, and shareholders' equity. These are at a specific point in time. And that is the fundamental accounting equation. So assets, that's the left-hand side of the balance sheet, equals liabilities plus equity. And think about if you bought a house for $500,000. So you, let's say you're going to set up a small business and you're going to purchase a house to rent. And so you're going to invest $150,000 into the purchase of the business. So you're going to, most lenders for a rental require a 30% down payment. So you're going to take, basically your ownership is 30% of the house. And then you're going to go to a lender and you're going to borrow $350,000 for this $500,000, or 70%. And that's going to be the liability. And so technically, if everything went, the loan went bad, the lender would take ownership of all of the assets. So the lender is owed $350,000. He would take ownership of this $500,000 asset. He would liquidate it, that means sell it, and then he would take the proceeds of the sale, which would hopefully be $500,000 or more, pay off what is owed to him, his liability, $350,000, and then give the remainder to the stockholders. So if everything stayed the same, everything would be in balance. But if everything was in balance, the lender wouldn't have had to take over the asset. So this is the fundamental accounting equation. And assets, it's on the balance sheet. Assets equals liabilities plus equity. So those are these three bullet points: assets, liabilities, and equity. They are at a specific point in time. It's a snapshot of a company at a specific point in time. Revenues and expenses are over a range in time. So revenues and expenses go on an income statement, and revenues are income generated in the normal course of business. So revenues, for example, Apple sells iPhones. The amount that they sell the iPhones for, so let's say it's $1,000 a phone, that is the revenue. It's not the income, it's the revenue. And then that's going to be over a range in time. So it's the income over typically 1 year, 1 quarter, or 1 month. So the difference between the balance sheet, which has assets, liabilities, and shareholder equity, that is a point in time. Revenues and expenses are over a specific range in time. And so companies will have, they'll issue quarterly reports and annual reports. And the balance sheet will have the value of the assets, liabilities, and shareholders' equity as of the end of the period, the quarter or the year. And then they'll have an income statement either over the last quarter or over the last year, typically. Most companies do not report on a monthly basis. And so I basically said revenue was not income. So this says income generated from business investments, goods, services, interest, royalties. It's the cash, it's the sales. But net income is revenue minus expenses. And then let's talk about a little subtle item. It's called cash accounting versus accrual accounting. So cash accounting, it accounts for transactions as the money is spent. So for example, I'm going to give you an example of this in just a second, but it accounts for transactions as the money is spent. And it's accrual accounting is you account for the transaction when it occurs, even if you haven't received the cash or paid the expense. And This is required for companies with sales in excess of $5 million a year. So what's the point of me telling you about this? Just so you're familiar with the term. Most of you, when you graduate, are going to work for companies with sales in excess of $5 million a year. And so it will have, you'll be using accrual accounting. I just want you to recognize that there's a difference between cash accounting and accrual accounting, because accrual accounting isn't exactly logical. Cash accounting is very logical. Let's look at revenue recognition for cash accounting. You sell a guitar to somebody in January. The customer pays the invoice in February. Now, let's take this back. If that were the case, you would have potentially have an accounts receivable, depending upon the type of accounting. But on cash accounting, the company recognizes the income in February. That's when they receive the money for it. For accrual accounting, the company recognizes the income in January, because that's when the sale was made. Expense recognition. If you purchase something in November but pay the invoice in December, cash accounting, you recognize the expense when you part with the cash. Accrual accounting, you recognize the expense when you actually make the purchase. Now, it's not intuitive. Most of us think about income and expenses in our personal lives on a cash accounting basis. Accrual accounting happens and is required by FASB and the Securities and Exchange Commission. It happens that you account for the revenue when it's generated, not when the cash is paid. Now let's look at a specific example for cash accounting. You own a company, you hire consultants for another company, and you charge 100% markup on the services. So, for example, if this company needs some work done that you're working for, you hire this other company. If they charge you $50, you charge $100. So in month one, the customer that you have wants to build a website. It costs you $500 to build the website. So you charge the customer $1,000. And the customer pays you the same month the service was completed, and you pay the specific consultants that same month as well. Month two, this customer wants to hire you for some other services. They're going to cost you $300, so you're going to charge the customer $600, but you're going to agree that instead of being paid in month two, you're going to get paid in month three. So in month three, you get paid the $600, you pay the $300. You have another customer, and they want to hire a specific consultant that you will not be able to get until month four. The customer is going to pay you in advance for those services. They're going to pay you $500, and then you're going to pay $250, but you're not going to pay for that until the fourth month. And then at the end of the fourth month, we're going to basically say we're going to have a look-see at everything that's happened over the prior 4 months. So let's see what happens here to revenue, expenses, profit, and cash. So month one, we see $1,000 of revenue. We see $500 of expenses. So we charge the customer $1,000 of that. We're paying $500 for the service. Our profit is $500, and we have that $500 in the bank. In month two, and I said this wrong when I described the problem, but we're going to pay for this service in month two. So we're going to go through where we hire the consultant for $300. We're going to charge him $600. So we're going to pay $300 in month 2, but we're not going to get paid for it until month 3. So we have to pay the $300. So we have effectively a loss of $300 because we have no revenue, we just have expense. We've paid the $300, it's going to come out of the cash balance of $500. We have $200 in the bank. Month 3, we get paid $600 for the prior month, and this new customer is going to pay us $500 in advance. So we have $1,100 in revenue. We don't have any expenses in month 3 because we've already paid the $300 in month 2. And so we have profit of $1,100, and now we have cash in the bank of $1,300, $200 plus $1,100. And then finally in month 4, we pay that last bill of $250. We've already received the revenue for it. So we have profit of a negative $250, and our cash in the bank is $1,050. So this is cash accounting. What I want you to pay most closely the attention to is the profit and cash in the bank. So all of these numbers under accrual accounting, many of these numbers are going to change. So let's look at the same situation where we exact same thing, but we're going to be doing accrual accounting. So in month 1, we have revenue of $1,000, expenses of $500. We have profit of $500, cash of $500. Effectively the same as we had under cash accounting. So these numbers are all the same. We don't have any receivables, we don't have any deferred revenue. Month 2, we are going to have expenses of $300, just like before. We are going to recognize the revenue of $600, even though it didn't happen. So we're going to book profits of $300. Cash in the bank is $200. We're going to have a $600 receivable. The company owes us $600. So let's compare that to cash accounting. We didn't recognize any revenue. We had negative profit, and we had $200 in the bank. Here we're recognizing the revenue, we're recognizing profit, and we have the same amount of cash in the bank. Now in month 3, there's really nothing new happening. We do get paid the $600 for the work from the prior month, and we get paid $500 in advance for work that's going to happen in month 4. But the $600 was already accounted for in month 2, and we're not going to actually do the work until month 4. So we have $1,100 of cash coming in. So the $200 and the $1,100 gives us $1,300. We no longer have a receivable, but we've received revenue that we now have to pay, and we will have, but we have no revenue and expense that's accounted for. And then finally in month 4, we actually pay the $250. We recognize the $500 of income because that's when we're doing the work. So we show profit of $250. Recognize in month 3 we didn't show any profit. And then we have cash on hand of dropping $250 to $1,050, and we've cleared out the accounts receivable and the deferred revenue. Now, if we compare this month 4 to month 4 under cash accounting, we end up with the same $1,050 cash. Now let's look at our total profit. So we have profit of $500 minus $300 gives you $200. plus 1100 is 1300 total, minus 250 gives you 1050. That's our total profit, and that's our cash. Under accrual accounting, we have profit is 500, 300 is 800, 0, and 250 is 1050. So we have the same total profit, we're just recognizing it at different times. So the totals will always add up, but we're just recognizing them over different times. So that's the kind of the difference between cash accounting and accrual accounting. So that's all I wanted to cover in this lesson. I recognize that this is not super intuitive. It doesn't need to be super intuitive. The takeaways from this lesson are that. This is what I want you to remember. FASB and GAAP. Assets, liabilities, and shareholders' equity, a point in time. Revenue and expense, a range in time. The fundamental and general accounting equation, assets equals liabilities plus equity. And then there's cash accounting and accrual accounting. There's a difference between the two, and now you have an idea of what the difference is. Remember the $5 million. Accrual accounting is required for companies with $5 million revenue or more. You can do cash accounting or accrual accounting if you have less than $5 million of revenue. It's not super intuitive. I'm going to give you some examples in the next lesson and hopefully make this a lot clearer and see where we're going to be using this going forward.